Welcome to the world of quantitative investing basics, where data-driven strategies reign supreme. Ever wondered how algorithms can predict market trends better than human intuition? Let's explore how numbers hold the key to smarter investments. By analyzing vast amounts of data, investors can uncover patterns and make more informed decisions. Think of it as harnessing the power of information to navigate the financial landscape with precision and insight. Together, we'll delve into the foundations of quantitative investing and unlock the potential of strategic analytics. Join us on this journey as we demystify the art of data-driven investment strategies. Welcome to our course overview. Today, we dive into the essentials of quantitative investing. We'll start by unraveling statistical foundations, from mean to correlation, and how they shape investment returns. Moving on, we'll delve into factor models and smart beta strategies, uncovering the driving forces behind returns. Next, we'll explore portfolio construction through quantitative methods, emphasizing the art of building diversified portfolios. Lastly, we'll ground our learning with practical applications, offering real-world insights into quantitative strategies. Join us on this journey as we equip ourselves with the tools to navigate the dynamic world of investment. Ever wondered how math and statistics can revolutionize investing? Quantitative investing does just that. By harnessing mathematical models and algorithms, it eliminates emotional bias, replacing it with data-driven decision-making. Imagine analyzing thousands of securities simultaneously, spotting trends and opportunities with lightning speed. This method not only streamlines investment processes but also ensures repeatable, systematic strategies. In the fast-paced world of finance, quantitative investing is a game-changer. Ever wonder how mathematical principles can guide successful investing decisions? In Chapter 1, we delve into the essential statistical methods in investing. Imagine harnessing the power of data to predict market trends and optimize portfolios. Picture using statistical models to analyze risk and return, transforming complex numbers into actionable strategies. Embrace the precision of mathematical foundations as your compass in the ever-changing landscape of finance. Let's unlock the secrets of statistical methods and pave the way to financial success. Ever wondered how investors make sense of all the numbers in the financial world? Let's dive into 3 core statistical concepts that are vital for understanding investment performance. The mean, or average return, gives us a snapshot of how an investment performed over time. Think of it as the middle ground of returns, calculated by summing all returns and dividing by the periods. Next, variance measures the fluctuations around this mean. Higher variance signals more risk and volatility. Lastly, correlation reveals how different investments move in relation to each other. Understanding correlation helps in constructing diversified portfolios that mitigate overall risk. Remember, mean for the average, variance for risk, and correlation for relationships. In a nutshell, these statistical pillars are essential for investors to navigate the complex world of finance effectively. Ever wondered why statistics are crucial for investors? These numbers aren't just figures, they're the key to making informed decisions in the market jungle. The mean helps set realistic return expectations, while variance measures risk for a level playing field among investment options. Correlation, on the other hand, is the secret sauce for building a stable, diverse portfolio. By blending assets with different correlation levels, investors can tame volatility without sacrificing returns, a smart move known as diversification. Quantitative pros live and breathe these statistical tools, using them to seize opportunities, tame risks, and fine-tune portfolios. Mastering these basics unlocks the gates to advanced quantitative strategies. In investing, statistics transform market noise into crystal-clear signals, guiding systematic and repeatable decisions. Ever wondered how statistical tools can help us choose between 2 stocks for our portfolio? Let's dive into a hypothetical comparison of tech stock A and utility stock B. Tech stock A boasts a 10% mean return, offering a higher average return but with more volatility. On the other hand, utility stock B presents a 5.4% mean return, lower but remarkably consistent. The slightly negative correlation between them makes for an excellent diversification opportunity. In this analysis, we see the trade-off between risk and stability, shedding light on the strategic decisions investors face. In the realm of factor models and smart beta lies the realm of systematic approaches to generating returns. What are the key strategies driving success in this domain? Factor models unlock the secrets of performance through specific drivers, while smart beta strategies aim to enhance returns by targeting factors like value or momentum. These approaches offer a structured path to potentially outperforming the market. By understanding the nuances of these models, investors can strategically position themselves for success. Let's delve deeper into the world of factor models and smart beta, where the keys to enhanced returns await. Ever wondered how investment returns are deciphered beyond individual stocks? Enter factor models. These models unveil the driving forces of performance by grouping securities based on shared traits like size, value, or momentum. The renowned Fama-French three-factor model highlights how market exposure, company size, and book-to-market value ratios influence stock returns consistently across markets and timeframes. By understanding these factors, investors can construct more efficient portfolios, targeting specific return sources instead of relying on random stock selections. In a world of calculated risks, factor models offer a strategic edge. Ever wondered what sets winning investments apart? Let's explore the key factors that drive success. Stocks with low prices relative to fundamentals, known as the value factor, often outshine growth stocks in the long run. Small-cap companies, the size factor, historically offer higher returns despite the added risk. Momentum factor highlights how recent top performers tend to stay on top. Quality factor emphasizes strong balance sheets, steady earnings, and solid governance for superior risk-adjusted returns. And don't underestimate the low volatility factor. Less volatile stocks can defy traditional risk-return predictions. In a world of investment possibilities, understanding these factors can be your compass to profitable decisions. Remember, the right mix of value, size, momentum, quality, and low volatility can steer your investments towards success. Traditional indices like the S&P 500 follow a market cap approach, favoring larger companies regardless of quality or valuation. This passive method is cost-effective but may lead to overexposure to overvalued stocks. In contrast, smart beta strategies intelligently target factors like value, quality, or low volatility, aiming to enhance risk-adjusted returns. By systematically tilting towards proven return factors, smart beta is more active and transparent. It's a strategic shift from traditional indexing, offering a rules-based approach to optimize performance. In the clash between traditional index and smart beta, the latter stands out for its dynamic factor exposure targeting. Narration text: smart beta strategies provide a targeted, rules-based approach to factor exposure, offering potential for enhanced risk-adjusted returns. Ever wondered how smart beta actually plays out in the real world? Let's delve into a simplified demonstration of how a smart beta value strategy operates differently from a traditional market cap index. Imagine sifting through the screen universe, meticulously filtering stocks based on their value traits. These stocks are then meticulously scored and ranked according to their PB and PE ratios. The magic happens in how they are weighted, not by market cap, but by their scores. This unique approach leads to an allocation based on factor scores, shaking up the conventional norms. And just when you think it's settled, there's a periodic rebalance to ensure the exposure is maintained. Smart beta, where innovation meets investment strategy. Ever wondered how data can shape investment decisions? In Chapter 3, we delve into quantitative portfolio construction, revealing the power of data-driven strategies. By leveraging quantitative analysis, we craft investment portfolios with precision and insight. Using robust methodologies and cutting-edge tools, we navigate the complexities of the market landscape to optimize returns and manage risks effectively. Embrace a new era of portfolio management where decisions are rooted in data, ensuring a competitive edge in the ever-evolving financial world. Ever wondered how quantitative portfolio construction actually works? It's a systematic, multi-step process that starts with defining investment objectives and constraints. Managers set target returns, risk levels, and asset restrictions. Then, data collection kicks in. Historical prices, financial statements, and more are analyzed. Statistical models forecast returns and risks, pinpointing correlations. Finally, optimization algorithms determine ideal portfolio weights to maximize return or minimize risk. It's all rules-based, transparent, and adaptably repeatable as new data flows in. The quantitative portfolio process, a structured journey from objectives to optimal weights. Ever wondered how to construct a robust quantitative portfolio? Start by defining clear objectives, pinpoint return targets, assess risk tolerance, and outline your investment constraints. Next, delve into data collection, gathering prices, fundamentals, and alternative datasets to inform your analysis. Building models comes next, crafting statistical tools to forecast returns and gauge risks effectively. Then comes optimization, where algorithms work their magic to determine optimal portfolio weights within set constraints. As you monitor and rebalance, track performance, and adapt holdings as market conditions evolve. Constructing a quant portfolio is an intricate dance of strategy and adaptability, where each step is pivotal to success. Ever wondered how diversification really works in reducing risk? Imagine this: a single stock can have an annual volatility of 25%, but a diversified portfolio, spread across 30+ stocks, can slash that volatility to just 15%. That's a whopping 40% reduction in risk. The secret lies in the math of correlation. Combining assets with correlations less than 1.0 lowers overall portfolio variance. By prioritizing correlation analysis and strategic position sizing across different return sources, quantitative models leverage the power of diversification to mitigate risk without sacrificing returns. Key takeaway: diversification isn't just about spreading investments, it's about smartly lowering risk while aiming for consistent returns. Ever wondered how to remove emotional bias from investing decisions? Quantitative investing holds the key. By following systematic rules, fear and greed are kept in check. Plus, with the ability to process vast datasets, algorithms can simultaneously analyze numerous securities. But beware of model risk, simplifications can falter in unpredictable markets. Remember, the quality of data directly impacts decisions. It's a case of garbage in, garbage out. And while historical insights are valuable, markets evolve, challenging reliance on past patterns. Lastly, the complexity of sophisticated models demands specialized know-how for successful implementation. In the world of quantitative investing, precision is paramount, but so is adaptability. Ever wondered how mean, variance, and correlation can decode the mysteries of returns and risk in investing? Factor models unveil the secrets behind value, size, and momentum driving securities performance. And then there's smart beta, a rules-based strategy that offers proven results with transparency and cost efficiency. Portfolio construction becomes an art through optimization algorithms, crafting diversified portfolios that strike the perfect balance between returns and risk. In the intricate dance of quantitative investing, these tools are our guiding stars, illuminating the path to success in a dynamic market landscape. Crisp one-sentence takeaway: in the realm of quantitative investing, mastering mean, variance, correlation, factor models, smart beta, and portfolio construction is the key to unlocking profitable opportunities while managing risks effectively. Let's put your quantitative investing knowledge to the test with a quick quiz. Question 1. What is the mean return of a stock with returns of 10%, -5%, 15%, and 8% over 4 years? The answer is 7%, calculated by summing all returns and dividing by 4. Question 2. If two stocks have a correlation of -0.8, what does this suggest about their movements? They tend to move in opposite directions most of the time, making them excellent for diversification. Question 3. How does a smart beta strategy differ from a traditional market cap index? Smart beta strategically tilts toward specific factors rather than solely following market weights. Question 4. Can you name 2 common investment factors that historically yield excess returns? Consider value, size, momentum, quality, or low volatility. Question 5. Why does diversification help reduce portfolio risk? By combining assets with different movements, correlation less than 1, overall volatility decreases. In investing, understanding these concepts can lead to more informed decisions and potentially better outcomes. Congratulations on laying a strong groundwork in quantitative investing concepts. Now, let's propel your learning journey forward. Delve deeper by exploring portfolio optimization theory, risk models, and the application of machine learning in finance. Equip yourself with programming prowess in Python or R to dissect financial data, test strategies, and implement models. Get hands-on with real data, download historical stock prices, calculate statistics, correlations, and factor exposures firsthand. Stay inquisitive, immerse yourself in research papers, quantitative investment blogs, and real-world applications of these concepts. As the field evolves with new data and computational advancements, your analytical skills will be your compass in the dynamic landscape of finance. Keep exploring, keep growing, the possibilities are limitless. Takeaway: your statistical and analytical skills will pave the way for your future success in finance.